Hi there. So in this video, what we're going to cover is how to use Perplexity to analyze a stock from a fundamental perspective. And rather than trying to take up a principle and understand it and then apply, I gave it a very simple prompt to begin with. That what I indicated to Perplexity is that using techniques outlined by seasoned investors like Warren Buffett with fundamental knowledge and sound investment principles, how can I research stocks using Perplexity? What are the ideal set of prompts to study a specific company? I want to take right level of risk and at the same time invest in stocks which has appreciation in short term and create wealth in long term. So I gave the problem back to Perplexity itself that rather than me trying to analyze stock, tell me how do I proceed with it. So it gave a very comprehensive answer. By what I mean by comprehensive answer is it gave me clearly the principles that Warren Buffett applies while buying a company. Then it gave me a set of prompts and it also broke it down into different phases and how your research should be structured. So I want to talk about what are the principles that it outlined, what are the kind of prompts that it gave me, and then I will also talk briefly about how when I applied it to a particular company, what were the insights that I got and how it helped me in making a decision. So the first and foremost, it gave me a very good set of images. It started with this, indicating that the the principle of Warren Buffett in terms of taking a bet on a stock is to look at a company as a business. And when it looks at a company as a business, think of it as a castle which is producing something. And what's the mode that it is creating? And when it creates that mode, does it have enough insulation that it doesn't get attacked by attackers, which is the competition in the market, and it is able to sustain its mode for a long term perspective, and at the same time who's running the company. So that's what it summarizes in one single image. And then it has given me different phases in which the analysis needs to be done, and has given me a very good set of prompts which we will take you through. Now the first and foremost, from a different phases perspective, what it tries to outline is that understand the business. And what does it take you to understand the business? First and foremost, understand the business model, and which means that understand what's the primary business that the company is in. And if you don't understand that business, go deeper into it to understand the aspects which will help you in making a decision whether it will have the moat or not. Then the second part of it is to understand who is running the company, because only if the people have integrity and if they have been into that business from good amount of time, you can take a bet on it. And the third part of it is from a fundamental analysis perspective, that is to understand the competitive positioning, that who are the competitors and whether this company is genuinely having the moat when compared to existing competitors, and if there is enough barrier to entry for new competition to enter into the market. The second part of it, once it has you figured out the business model, its competition, and who's running it, the second part of it that it talks about is to figure out, based on the last 10 years or whatever time you can pick up, what are the financial indicators indicating, what is the profitability. And when it talks about profitability, it is talking about the return on equity, return on assets, and what are the profit margins, especially when it is trying to benchmark against the specific aspect, because Warren Buffett has a specific benchmark that return on equity should be greater than 15% for most part of the last decade for you to be able to take a bet on that company. The second aspect being that analyze the debt levels, cash positions, and the financial stability, whether it has been able to navigate some of the crisis and how it has navigated through it. Then figure out the cash flow part of it. So these are all indicators which are available in the financial statements, the audited ones which are submitted to the market, and there are prompts to support each one of them. And once you figured out the company's business model, you figure out the financial stability, you can see how it is positioned in the stock market. And this image kind of captures that like look for the intrinsic value calculation. What it means is that figure out whether the business that is today you are buying at a given price, is it making sense, is it overvalued, is it undervalued. So figure out how it is in terms of the P, uh, from its industry standpoint of view, and then historically how has the market previewed this company and where is it standing today. Because if a company was trading at 35 and now all of a sudden there is some growth, but the pricing has gone up fairly and it is now trading at a P of 70, then it might not be a good idea to enter, and that's where the margin of safety assessment comes in. So it gave in that perspective. Now, since I had also given it that I want to build my portfolio around short-term and long-term bets, so that's the other part that it covered over here. But we'll come back to it because there are more phases or more aspects of how to evaluate a company that were brought in which the additional aspects were the risk assessment part of it. That figure out what is the industry risk, what is the management risk, and then understand the bets that you're taking from a long-term perspective. And it summarized this, that this is the kind of a framework that you're talking about when you are making an investment decision based on Warren Buffett principle, that understand what's the opportunity that the company is trying to tap into. Is it having a business which is having enough moat that it is able to compete in the market with current competitors, and there is enough barrier to entry, and is it being run by people who can be trusted, because you really need competent people at the top. You don't have much control. So then the financial aspect of it, figure out how it has performed over the last decade or so, depending upon how long the company has been in business. The other aspect of it being the valuations before you take a investment decision, a yes or a no, that is it undervalued or overvalued. And it gave me as I mentioned earlier, it gave me a very comprehensive set of prompts to help me run this. So I'll just open it and go back to it. Although there are 3 or 4 major phases in which it has divided it, but the aspect in which it has given the prompts is lot more comprehensive, and you will take 35 to 40 minutes to analyze a particular company, but you really get a very good insight into how a company is performing. So as I mentioned, the first phase being just understanding the business model, and it has these kind of prompts that understand the business model deep dive, and it gives this prompt which is how the company makes money, its primary revenue streams, target customers, and competitive advantages. Include Warren Buffett's concept of economic moats, what's barriers protect this business from competition. So that is as good as it can get. Then it talks about the management, as I mentioned, who's running the company, how long have they been in the system, and what is their skill set, and are there any major red flags over there from an individual who's running that. Then figuring out how is the company doing from a competition perspective. So that's primarily helping you understand the business. Then the second aspect phase, as I mentioned earlier, is to figure out the financial health, which includes the profitability and growth analysis. And it takes in the last 10-year period, includes specific aspects of ROE, ROA, profit margins, then the balance sheet strength in terms of debt levels, because especially for cyclical investments, you really need to understand the debt levels, and sometimes as the inflation goes up and the debt levels reach a surmountable level, things can go wrong. So it kind of captures that. Then figuring out the cash flow part of it, free cash flow and other aspects of it. So it gives a good picture, and I have applied this to a company called Craftsman Automation. I'll take you through that part of it. Before we go there, let me just walk you through all the phases that have been defined and the prompts that have come up. So then is the valuation aspect. As I mentioned earlier, first figure out the business, then figure out the financial aspects of it, then the valuation, and valuation from the perspective of how the company is in terms of its peers, in terms of the valuations, and then how the company has been previewed over the last decade in the stock market, and see whether it is undervalued at this point in time, is it fair value, is it overvalued. And then it is talking about the different additional risk that you can evaluate, like in terms of the aspects of regulatory challenges, competitive threats, management risk, and financial risk. So it has given me that kind of prompts. Then the red flags to figure out specifics, debts, declining margins, and there are benchmarks against which have been, put up. And when it gives me the reports, it actually provides that these are the red flags, that what you call as excessive debt. And these are some of the key ones. After that, there is also about the growth potential in terms of how the industry is expected to grow, how this particular company is expected to grow, dividend and capital returns. So it gives a very comprehensive set to understand the possible risk, possible growth, and then comes down to that, summarize all of this and see if there is enough margin of safety, then bring in this. And additionally, there are more aspects to it if you want to go specifically on, how the sector is comparing, what are the management track records. It has given additional prompts. But when I started trying it out, what I found was that it really helps you understand a company very well. So I started with a company called Craftsman Automation, which is an Indian company and it is into automotive industry. It provides parts to the automotive industry, and started off pretty well for me to understand that it is having a good CAGR growth of 31% over the last 5 years. And I had made some bets in this company, but these were only technical bets. So I was trying to understand that whether this company is something which I should build in the portfolio. It helped me understand what is their core business, what are the different revenue streams it is having, and while it is having these different revenue streams, how it has performed over the last 5 years, who are the primary clients, and if these clients are having other options. So what it summarized for me in terms of the business aspect of it is that they have a reasonably good moat. What they are into is not readily available from other manufacturers, and companies which are taking a dependency really look for long-term contracts. So it's not very easy for a company which has gotten into a contract to shift from this company to some other manufacturer, and that is why there is a lot of advantage or a moat that is built into it. So that was one part of it. Then the second part of it being the fact that who is running this company, and the CEO for this company is there for last 37 years, and the company has waded through different crises fairly well, and there's enough promoter ownership. So what I found was, at least when I look at it from a business model perspective and business evaluation perspective, the company stood in green. And although it also gave me this chart which kind of shows me how the pricing movement has been, and it is a volatile stock, which is okay. But as I moved forward, the next part of it was obviously to understand how it is vis-a-vis competition. And this is where really it shines, and it helps you figure out, because even before you go down to the stock market, how is the company vis-a-vis its competitors on various aspects in the financial part of it. It brought in that piece of information right here itself in the form of images after I gave it the competition clause. And what it gave me as an outcome of this prompt is really awesome. Detailed competitor analysis of Craftsman Automation. Who are the competitors? What is the company's market share? It gave me this particular outcome, and it shows me that yes, Craftsman Automation is doing well, CAGR is good, but ROC has been well below 15, and whereas its competitors and all, if you look at it, a lot of them are doing a lot better. So generally this was my first red flag. And then as I went deeper into it, I figured out that debt levels have been also increasing, and all of this comes through the prompts that have been provided. And what I figured out is, and while I was doing it, what I was not very clear was about the business model, because what I didn't understand is that one of their key components is cylinder block, and I was just trying to understand whether the cylinder block would be required in the manufacturing of automobiles which are based on green energy. So it gave me all of those answers, whether the business model is sustainable or not, how is the ROC working. And at least for me, what I figured out was that it for me is not one of the best companies to invest in, because if I look at ROC is not the best in the industry. Then the other red flag was that the ROCE and the profitability in general is below the benchmark for a good 10-year period, because the Buffett benchmark for ROC is approximately 15% and above, whereas this is going a little down. And there is also a downward trend in that. So I was not very convinced, but the key part of it is not so much about what it is doing in context of craftsman automation, but what information it is able to bring in a packaged form and then help you make the decisions in such a manner that yes, you feel confident. So over here, if you look at debt to equity also, it is fairly above the benchmark. This is a red flag, and so the debt is not looking that good, ROC is not looking that good for this company, and the PE ratio for that matter, is also not looking so great. So for me, where it stopped is that this is not the best company when I look at automotive industry. Yes, you can take a technical debt and technical positions and play around with it with a smaller amount of money. Now, but the key part is that you get all your prompts and you got all your research, and finally if you want to synthesize it and want to run all of these prompts together, you can do that also, which I'll cover in the next video. I'll be also figuring out how to study industries using Perplexity. This was very quickly how you can leverage Perplexity to research a stock. You will have access to these prompts. I'll see you in the next one. If you liked it and you're watching it on YouTube, definitely like, subscribe and share the video. Bye for now. I will see you in the next one.